Retiring with $400,000 in the bank, that's not even $500,000. You can have $400,000 in your bank in 10 years. Let's be honest though, it's hard to achieve this in 5 or 10 years unless you put away like $50,000 a year. Even 10 years is hard. You'll need to put away $2,375 a month. But if you put away $666 a month, or $8,000 a year, or $21 a day, then you'll be able to retire in 20 years with that $400,000 in the bank. I'm Jacob Fisher, and this is how you can retire in 20 years. Make sure you smash that like button real quick to help with the YouTube algorithm. Now let's get into it. First off, I think I need to say this. I'm not an investment professional, and all of this should be taken with a grain of salt because I'm not a professional. Use this as you would to expand your potential options. Maybe you like my ideas and want to give it a shot, but want to invest in something different. That's perfectly fine. Again, not a professional, so don't do exactly what I'm saying. How can you retire with $400,000? Well, what are dividends? Dividends are a distribution of reward from a portion of the company's earnings and is paid to a class of its shareholders. For example, Apple pays a dividend of 77 cents per share that you own. That means if you own 100 shares of Apple, you'll be paid $77 per year just by holding the stock. In general, dividends are taxed at the normal tax rate for your income or capital gains tax rate for special dividends. Your broker will tell you which are which, and you'll get that on your tax papers come April. I know some of you are doing the math right now and saying if you own $400,000 worth of Apple, you would have about 1,362 shares and earn only $1,049 per year from them. That's why you need to look at high yield dividend stocks. Consider this. If your expenses are only $2,709 after tax per month, then you can retire on $400,000 in savings. Pretty much what we are searching for is a guaranteed way to make 10% per year from dividends. On $400,000, that will give you an income of $40,000 per year pre-tax. We also need to consider the average stock market return is 10% per year, of course, minus 2 to 3% for inflation. That also means investing in normal funds should increase your nest egg by about 10% per year. So, should you go with dividends or normal stocks? I think dividends are more worthwhile, just because they give you that money every year. If a stock has a set rate of return for dividends, that's what it's going to do. And sometimes they increase them, sometimes they decrease. It all fluctuates, but you have to adjust that accordingly. You have to have a more active investment profile. I've come up with 16 stocks using TD Ameritrade Scanner to allow for some diversification on all dividends greater than 10% per year. Keep in mind, I also need to find stocks that weren't going bankrupt and just offer these high dividends. There were a ton of real estate funds offering these high dividends. Just take a look at this. All the stocks I found were continually increasing or staying the same in value and did not have a sell rating. Now this could change weekly as is with the stock market, plus it does not help that the coronavirus is affecting current trends. Once that clears, we should see an increase in the overall trends. Let's take a look at that. ARR, 10%. Dividend, it's real estate. FPL, 10.03%. It's an energy fund. FDEU, 10.05%. Europe Equity Income. TCPC, 10.06% small cap value, capital market. AGNC, 10.06% real estate. THW, 10.13%, it's healthcare. EOD, 10.44%, it's Wells Fargo Dividend Opportunity Fund. TWO is 10.55%, it's real estate. GLV, 10.77%, dividend and income fund. USDP, 15.23% dividend, oil and gas. NBR-A, 18.59%, energy equipment. This one is interesting because I could not add it to the index fund that you saw for the investment profile. It's because they're changing the name and the stock goes away and comes back every couple months or years. IEP, 11.8%, which is Industrial Conglomerates Midcap. S&P, 10.71%. Oil and gas. This is a China stock, so it's taking an especially hard hit right now. DKL, 12.09%. Oil and gas. VGR, 12.12%. Tobacco, small cap blend. Now it's been noted that tobacco has been the highest rate of return for dividends. That's just kind of how it is. Many of the funds here are closed-end management funds, so they are run by a manager and they can only be bought by, well, us. An investment bank can't come in and help with the purchase of these accounts. It is actually managed by this fund manager as well. You think of an ETF, generally it's more laid back. They hold it and then it goes on and grows. There can also be an expense ratio for these funds as well. Obviously, you don't need to invest in these names, but just consider your options next time you feel like getting into some long-term dividend investments. These names with higher dividends are riskier than names such as Apple with a lower dividend. Sometimes a company like Apple will offer a greater dividend than before. Costco did that a while ago when they gave out $7 a share. That's a good deal. After an especially good quarter. This was in 2017. Costco, again, being a safer investment. It is possible to find names around the 3 to 6% that you might trust more. If you want to make $40,000 a year, then you'll need anywhere from $666,000 and $666 to $1.3 million in your account, earning you that dividend. A bond ETF I recently found called JNK gives you 5.3% back per year. Consider this like a high-yield savings account to replace Robinhood's lame 1.8% saving account. I hope you found something useful from this video. If you did and want to offer your thoughts, then leave a comment down below. Don't forget to smash that like button for the YouTube algorithm. Thanks again for watching. Friday will be flying.